Luke Downey, thanks so much for coming back on Wall Street Unplugged.
Good to hear from you, Frank. Glad to be here.
So we have lots to talk about, including really good news, Curzio research, and you get to it in a minute, right? And also I want to get to your whole MAPsignals, how you select stocks. But before that, let's talk about the markets, right? We just ended 2020. Pretty crazy year. S&P 500 surged 16%. NASDAQ did a lot better than that. And now, you've been writing for us a long time, and you're saying that you're a little worried because they're showing extreme overbought levels. And I guess my question to you, haven't we been overbought for a while? I mean, a lot of things that I'm looking at, it seems like we've been overbought for a little while. But what are your thoughts on the market now, coming out of 2020 and going into 2021?
Yeah, great question. Great setup. I think if we could rewind a little bit, we look at 2020, something pretty amazing happened in 2020. I did a study, and we actually published this on your website on one of my contributions, but nearly 50% of 2020 spent overbought. And that was pretty amazing because that hadn't happened in over 25 years. Now, obviously, we know we had a pandemic, so things are, a little bit strange and everything's acting a little bit out of the ordinary. But for half of the year, practically, markets were overbought. And I think everybody's 401ks, brokerage accounts, everything basically was at all-time highs. And then I think we kind of came into this election setting for November. We did a really cool study that said, and this was before the election, that typically, on average, going back to 1990, big money moves out of stocks prior to the election, and then big money moves into stocks in a very big way after the election. So basically, it's like, there's this uncertainty that happens. Maybe these big fund managers, they de-risk a little bit, or at least flatten out. Then once they know who the victor is, or who they think the victor is going to be, then they can go and place their chips. And that's exactly what happened, not only from a historical standpoint, but also happened in 2020. And so it didn't take long for us to get overbought again. And so now to your question is, we are extremely overbought. And the way I look at that is it's basically, what is the big money doing? And we have this really cool indicator. It's called the Big Money Index. I think, I live and die by this thing. And it basically just tracks, how many stocks are going up with this big money activity, how many are going down with this big money activity. And whenever we hit these lengthy periods, 4 weeks, 6 weeks, 8 weeks, whatever it is, it tends to be unsustainable if we're overbought, because, markets have to correct. And I find corrections are really good for buying great stocks on a discount. Maybe there were some names that, we may have missed out on in this big rally. And so what we're thinking about right now is we're very extended, very overbought. The data historically says that there's a good chance that we could see a modest pullback maybe at the end of January.
That's interesting. I mean, only because I would think if you're looking at the markets and looking at fundamentals, right? And you look at institutional money coming in out, which you're going to talk about through MAPsignals and stuff, which has been fantastic, guys. Luke writes for our site, Curzio Research, and his finds could be there. We have just so many testimonials about you and positive things that you've helped people, and your stock picks, your market, everything's been like dead on so far, and you've been writing for us for a long time. But when I look at this market, looking at it trading at 22 times forward earnings, which is 60% higher than the 10-year average, and you're looking at earnings where you're not seeing the massive growth. You're seeing the rebound in earnings, of course, because they came down so far, but it doesn't even seem like we're going to have the earnings growth there. And it just adds to how important the stimulus is and how important Fed policy is, because that's really driving stocks. And I don't know if that's going to change or not, but maybe that's what I got wrong, because I thought we were kind of overbought, saying, hey, guys, don't come out of the markets. For me, I've learned my lessons. Never sell things that are going higher and higher and higher. You could take some off the table, but don't sell your full positions. But even now, it just feels like with that thesis, I've been wrong. I've been long, but, just took some off the table. But it has that feeling like, is that the right strategy? What's different this time? And I don't know if you feel that way, because there's an underlying current under this market that doesn't make sense from a fundamental or maybe even a technical view, where, we're relying on stimulus and the Fed, and these guys, think a recession or not a recession, but just your normal pullback or a correction is very, very bad when this is a normal course of action for the markets going back hundreds of years, over 100 years.
Yeah, no, I think the only thing that I could really compare 2022 was what we saw in 2008, and I had a front row seat and watching just that complete collapse and watching my customers, a number of them just went under. And then, once the Fed, got involved, it basically was like a reset button as far as I was concerned. That was kind of whenever, Jesus took the wheel and everything basically rallied, for the next, decade, right? I think a little bit of that happened in 2020, and that's kind of the way that we've been positioned and the way I've been thinking about things is, the Fed had to step in, and we discussed this in March. It's a great time, to be on your podcast, and there wasn't any announcement yet of what they were going to do and how far the stimulus was going to go, but there was a sense and there was this urgency that they were going to do something, and I thought they were going to do something in a big way. I think whenever they do that, Wall Street knows, at least historically, that that's going to be good for stocks. That's going to be the ballast that we need, that is going to help us bridge the gap of those missed, those that earnings drought. And so, you look here, and if we just fast forward past January, even if we get a small pullback, I still think it's going to be a great time to be adding to stocks, because I think the comps that are going to be coming in Q2 and Q3, I think it's going to be easy to beat. And I think that that's what Wall Street, I think that's what their models are really looking at is, are we going to have stacked growth for the next couple of years? And it seems like that is the case. And if we all agree, or if we think Wall Street agrees to that, then, we're going up, up, up over the long term.
No, and I want to get into how you make these forecasts, because, we have been interviewing analysts for over 13 years now, 14 years on this podcast, and everybody has their opinion, but you actually have a certain system, which you write about on our website, Curzio Research, and it's your MAPsignals, where you're following the big money. And I guess my question is, when you're following the big money, I've always prided myself on being contrarian, but if you follow the big money, you could still be contrarian, right? Because sometimes you'll see big money flow into ideas and you're not really seeing them talked about a lot in the media. Does that factor in? And let's go into, MAPsignals and how you come up with these forecasts, because, if guys, seriously, it's for free. Go to Curzio Research. If you read what Luke's been writing, since he's been writing for us for a while now, you can see how accurate it is. And it's based on this MAPsignal system, which, you on your website, at least 1.2 million pieces of data that you're analyzing on more than 5,000 stocks. So, it's except for penny stocks, but there's a lot of effort that goes into you just coming on this podcast and saying, hey, we think we could see a pullback in January, isn't it?
Yeah, totally. I mean, just this past weekend, I spent hours and hours. My wife was like, what are you doing? And, Frank, me, I love this stuff. This is outside of my family. This is what I think about all the time. And what we're able to do and to make these forecasts is we basically are just measuring all of these thousands of stocks and to see if there's a trend, right? Is that underlying trend that money appears to be going into these stocks, or is it coming out of these stocks? And it doesn't matter if there's a rotations happening, because we can still look by sector, we can still look by ETFs and all of that. And so we use that as our framework. And now that we've been in business for going on 7 years, there's a little bit of muscle memory that kind of comes with this, meaning like, have we seen this before? Right. And so whenever we start to see these thematic plays start to unfold, we're able to circle back to a prior time in history, whether we were in business at that time, and then make a forecast from there. And a couple of years ago, we filled in our data all the way back to 1990. So we did a pretty extensive, took a long time to do this back test. And what we're able to do is kind of look back and say, what is similar now that happened in certain periods. And then we can kind of formulate an action plan. And even though that's just the data framework, we also have to use our noggin on top of that. We have to sit here and say, okay, well, what was happening the last time that we saw any type of stimulus that was similar to this? And then also, we have the advent of ETFs. Those kind of got started really in a big way in 2005, and that's really kind of been a driving force for us to look at big money. So big money may be hedge funds, maybe pension funds. It could be ETFs. It doesn't matter. It's just, where is the flow of money coming? And most recently, probably the Robinhood traders have taken over Wall Street, and so that's what really is helping us to make these forecasts. It's all based on data. It's not based on gut. It's not based on feels or anything like that. We don't get it right all the time, but definitely it's a very extensive thought process of which way you want to lean with your portfolio.
Now, when I look at this methodology, it seems like it's focusing on growth stocks. Is that just where the institutional money is going right now? Because we are seeing kind of slow down a little bit, but you saw the airlines bounce back over the past couple of months. A lot of travel-related value plays that have gotten crushed, caught a bid, even energy caught a bid. Those aren't growth stocks. But it seems like you focus on a lot of growth names. Is that because of the system, or is that just something that you do where this has been the way the market's been in 10 years, and it doesn't seem like it's changing, where growth is definitely outpacing and much more favorable than value?
That's a great question. So the main reason is, whenever we look at everything just from a data framework, every stock is looked at individually on its own. Now, what we do and what we learned to do whenever we were trading on institutional trading desk is that there were higher quality names than other names. And so we came up with this really cool ranking process where we would actually score the stock based on not only the big money activity, but also the fundamental health of the company. So, are they growing their sales? Are they growing their revenues? Is there a narrative? Is there better guidance, et cetera? And then also just ranking the technicals of, how the stock is actually trading. So I myself personally have always loved growth stocks. I really wasn't interested in finding a stock that's going to perform in line with the S&P 500. I've always been looking for the next Netflix, and I was lucky enough to get that one. The next Tesla, I was lucky enough to get that one as well. And that's where I think that, I'm trying to be is I'm trying to not only just beat the market, but find these outlier stocks that, history has shown that about 1% of all the stocks make up most of the gains for the stock market going back to, nearly 1920.
And that's a good point. I mean, interesting stat that I saw yesterday, which you may know. I didn't know, but you're looking at the market where it did so well, right? It's up 16%, the S&P 500. If you're looking at the individual names, 40% of them showed negative returns last year. I thought that was extremely high. Extremely high. I know energy financials are in there. I get it, but I was like, wow, I didn't. You think that all you had to do is throw a dart and everything came back since March, but not necessarily the case when you're looking at individual names.
If you're not in the best of the best, you're not seeing the gains that what we're basically seeing on some of the other outlets that you see, and that's kind of been the whole crux of trying to score and to actually rank names is, if you're going to get into the investment game and you're going to pick single stocks and specific stocks, shouldn't you be glued to the ones that are changing lives and making new all-time highs consistently, and they're basically having a moat around their business and changing the way we live our lives. I mean, that's the type of stuff that we're looking for. And I've always, even as I've gotten a little bit older, I'm looking for that high octane but high quality stock.
So now for the big news. Talking about your methodology so much, and hopefully I love talking about that and learning. So hopefully that comes across to investors. Sometimes you're just like, Luke, just give us a pick, and we'll go over that later on and see what you like or what you're seeing based on your system. But you talk about growth stocks. I felt like that was a huge need for Curzio research. I always have people write for our sites first. And look, it's writing, and to me, it's more of a character thing to see, how serious you take it, how much data you're providing, and how you're educating my investors. And some people say, I'm only going to write a couple of weeks. This isn't worth it. You've done it for a very long time, to the point where, we look at this, and when we get positive response, we want to do what our customers want us to do, right? As much as we can. We're not going to start like, some crazy newsletter that only has, in an industry it's not going to work. We're not going to make money off of. So, but we always want to follow what our customers want. And they're looking for growth stocks. They're looking for a way to play this. And we decided to partner with you to start a newsletter. It's going to focus on growth stocks. Very exciting in early stages. If you are a Curzio 1 member, you're going to get beta versions starting at the end of January. But, I just wanted to introduce that because I'm really excited to work with you. And that's the first of a newsletter where it's going to be a front at a very low price so people could see your work. But then we're going to come out with something more sophisticated, not too sophisticated, but it's, a back end product where you're actually going to be focused on options and things like that, right? Why don't you talk about, how you approach the market using MAPsignals, that methodology, and say, hey, you know what, Tesla came up on your list a long time ago, but also, when you really see something that's exciting, you have option strategies around. Is that correct?
Yeah, definitely. And thanks for bringing that up. I'm really excited about the partnership and talking about stocks. This is what I love to do. This is what you love to do. And if this fits a void that Curzio Research can utilize, I'm all for it. So I'm really excited. I think it's going to be really great. And to talk about what we'll hopefully be working towards is number one is isolating just a lot of these growth names that might be on people's radar, may also not be on people's radar. Try to find these companies that are early in their cycle, that are growing in a healthy way. They dominate their space. And in terms of how long we might hold that, it really just depends on how much are we making in terms of return. I'm more of a longer term minded investor, so I kind of have a two-pronged approach. One is you want to have your outlier stocks, you want to have your great stocks. That's kind of your core, and then there will be these periods through data that we can make a change. If we want to lighten up a little bit, and that would be based on big money's coming out of stocks. Maybe you do an options trade during there. Whenever markets get oversold, that's a great opportunity where you can limit your downside by using options. Same type of stocks, same type of profile, and really just as markets are extreme and crazy, I think it'll be a balanced approach of not only using data but all the things that I've learned over a decade plus of being an investor.
Yeah, and with your institutional background and institution, what I love about you, which is rare, Luke, is that even through your writing on our site, is you explain things to average investors, which is important. It gets lost in our business so much. Especially, I came from the sell side as well, but it's important because most people out there are looking. They have their full-time jobs. They're looking for us for ideas and learn about the markets. And you have people talk about EBITDA, enterprise value, moving averages, like we talked
right.
about institutional inflows, outflows. You explain everything in detail of what that means, why it's different this time than other times, and it's. I mean, the importance of that, I can't overstate. It's just incredible because that gets lost in a lot of people when they're writing and they come to me and say, hey, can I mark? I was like, you got to make it simple because people don't understand what you're writing. They're not going to subscribe to your work. So it's amazing how you put everything in perspective for average investor to understand exactly why you're buying the stock. Everything you write about, you explain, which is really cool. And I'm really excited to launch our first newsletter with you. And that newsletter will probably get launched, I would say, around March, and the back end will come out maybe a month later or so. But we are going to provide beta issues to Curzio 1, who, those members give us feedback and say, hey, we like this, we don't like this. And we try to tailor it because, we care about our customers here and like every business should. So we want to basically tailor it to your needs. And now they're going to get access to a lot of growth stocks that, they might not have heard to. And hopefully, some of the ones that get invested in early that become the biggest names where we've seen, man, Tesla, we've seen, people look at fundamental, they can't understand it, but Tesla, Zooms, just the Pelotons and stuff like that. It is pretty crazy. And having access to that, knowing how to invest in that is going to be really cool. I think people are going to get excited.
Yeah, no, I mean, it is boom time right now. And, I've been holding a lot of names over years that I've collected. And just to see the power of, some of these outlier stocks. I mean, just look at Tesla. I think I bought that one back in, I think it was 2000. It was either 2010, 2014. I'm not even exactly sure. But the thrust that stock has had. And I mean, there was half of Wall Street was, shorting it. The other half was saying that it was bullish. I was just looking at, what's the big money say about that one? And obviously that one turned out to be one of my biggest gainers of all time. But that's what we're trying to do is, if you can, spread your risk out a little bit, get some of these. I mean, that's kind of like my cryptocurrency play. I just put a little bit of money in Tesla, and it turned out to be a pretty nice position. I'm not a cryptocurrency guy, but to me, it was the same type of asymmetric risk profile. So yeah.
No, that definitely makes sense. So okay, let's get to the last question here. The most important, which everybody wants to know. So based on your system, what you're seeing, you said you're expecting a pullback in January. Are you seeing anything where more institutional money is flowing into? I know it's, EV is seeing, social responsible stocks. I mean, you see this bid among different sectors, and even energy is catching a bid now, and financials. But you're seeing large cap technology pull back a little bit. I mean, pretty much underperformed the market over the past couple of months, especially, the Amazons and stuff. What are you seeing right now where, they're loading up on it, or, they're actually easing back? Is there anything you could talk about, or any ideas you could share?
Sure. Well, there's definitely been a big bid into industrial and material stocks. And so that could be, until we get to a reopen phase, they're going to have to turn the machines back on, right? And so I think that that's what's happening with a lot of these industrial names. We're starting to see also banks, coming back from the dead. A lot of those plays have been just beaten down to the ground. I think for most of 2020, they're actually coming back. Inside of that, to talk about big cap tech, yeah, there's a lot of names that have really kind of been stuck in neutral. But there are some of these smaller caps that I think a lot of people have been talking about, the small cap rotation that's happened post the election once the vaccine news was announced. There is a lot of names that are just exploding higher, and these are some of these sub 10 billion market cap weighted companies. That's some of the stuff that we've been looking at. And there's some definite, interesting plays that are in technology, smaller names, not necessarily these big tech names, but that's what we've been seeing as magnets for big money recently.
Now, I won't ask you unless you want to share individual names, but I know you're going to share individual names in your beta versions of the newsletter. But I don't know if you have any individual names. If not, that's okay. I know you're going to share them with subscribers going forward. But yeah, I wanted to see if there's anything that really caught your attention. That, again, not that you tell them to buy or right now, but something that, hey, you know what, it is interesting. It's not just materials, but specifically these companies and materials and banks that are seeing inflows.
Yeah, I think an interesting one that I've been looking at is it's a small cap name. This is definitely going to be on the, it's going to have a higher volatility than some of your other names, and that's Grow Generation. And this one kind of came up on our radar, I want to say maybe a couple of months ago. The ticker is GRWG. It's not for the faint of heart. They basically are based out of Colorado. They deal with soil, nutrients, any type of if you're in, horticulture or anything like that. But I think what's really interesting about this company is not only are they in a really cool space and a growing space, is if you look at some of their earnings and their guidance, they have just been beating and raising consistently, and the shares have been rewarded. And again, I think it's about a $40 stock, and it's gone up tremendously over the past year. But that's one I think that you could keep on your radar.
Yeah, it's amazing because when you say faint of heart and volatility and risky, everybody wants to buy it. If you say safe, it's kind of not too bad. Safe, paid. People are like, all right.
Yeah, no, I mean, listen, it's some of these names that you got to be careful if, God forbid, you short something like that. I mean, you see some of these stocks. I mean, they are just going moonbound. Once people get a hold of them. So. It's interesting. It's not really discussed that much. I haven't really heard this name that often, but it's got really strong fundamentals. It's got great technicals, and it's starting to see that big money activity. And so whenever you have that power three, it's something definitely to keep on your radar for sure.
Nah, it's great stuff. Well, Luke, looking forward to working with you, and a lot of people are going to appreciate that newsletter, and you're going to see stocks being bought after they've made nice moves, but they all have earnings growth, sales growth. We have some of these in our portfolio, but just having a newsletter dedicated to this and showing people how to make money on these things, because sometimes you focus on P ratios and things like that. And if you did, you'd never have an Amazon, you'd never have Microsoft breaking out here, you'd never have the Apples, you'd never have, the Netflixes, because you have to really look at their growth profile. And, as long as these companies continue to grow, it gets rewarded through their stock price. You don't fight it or whatever, but having a newsletter dedicated to that, I know my investors, my followers are going to be very, very excited. So I'm looking forward to working with you over the long term, not just a short term, but launching a couple newsletter with you. So I'm very, very excited, man.
Yeah, I am super excited too. I think it's going to be great. And, we'll be able to spit back and forth on the airwaves and, really just try to make people money. I mean, that's what it's all about. And I really enjoy this. I know you enjoy this. So I think it's going to be a great partnership. So.
No, it sounds great. Listen, hopefully you and your family have a wonderful new year into 2021 and saying goodbye to 2020, which was difficult for so many people. But looking forward to it. Hopefully you enjoy the year. Looking forward to working with you, buddy.
Same to you. Happy New Year.
Happy New Year.